Hello everyone and welcome back to the channel. Today I'm going to talk about Ferrari stock that I had it in my watch list for the last 2 years. And I believe it's finally getting to a range that I'm comfortable to start a position in this stock. If you have been following the market, Ferrari just suffered its steepest single-day stock decline since its IPO in 2016. The stock is down more than 20% from its recent all-time high share price in the past 2 trading days. And while this stock historically has been completely outperformed S&P 500 and S&P TSX in the last 10 and 5 years, now the stock is underperforming both S&P 500 and S&P TSX in the last year by a large margin. In this video, I will analyze the stock, I will explain why the stock price crashed by more than 20% and whether it is a good buy at this new price range. I will also use Yara IQ stock analyzer and discounted cash flow calculator to come up with a fair value of Ferrari stock. For me, Ferrari is a name that means exclusivity, prestige, performance, winning, and true luxury. So when I want to analyze Ferrari stock, it's not about their cars. It's not a car company for me. It's a luxury brand powerhouse. Ferrari is a luxury good and not a car for me. Ferrari is known for its high quality and low volume productions. They can sell a lot more cars as there is a lot of demand for Ferrari, but the company strategically don't want to sell a lot of cars to keep their cars exclusive and hard to obtain. It is one of the only car brands in the world where you can't just walk in a dealership and buy a brand new Ferrari. For high demand models, there are often long waiting lists that are prioritized for current owners of Ferraris. And therefore, most new models of Ferrari go to existing owners first, and you will need to try to buy a used Ferrari first, or go through a background check and follow brand rules for new purchases. Even then, Ferrari may require you to first purchase a less exclusive new model, such as Roma, before you can be considered for ultra-exclusive supercars. That's why Ferrari is not a car company, and it is a luxury brand product where they control the margins, how much they can sell their cars for, and how many new cars they produce each year. Ferrari has been able to increase total volume while maintaining its exclusivity in the last 10 years. Total volume has grown by 88% while there is still a lot of demand for their supercars. They can easily increase the price of their cars by $50,000 and still have more demand than supply for all of their cars. They are pricing power champion in my opinion, and it is a beautiful business model, and I absolutely love to own this business, but this stock was always trading for such a significant premium in the last 2 years that I couldn't basically pull the trigger. Unfortunately, I wasn't looking at Ferrari when it was trading for $170 in June 2022, but afterwards it was just on an absolute massive run where the valuation didn't make sense for me. But now it seems the market is finally giving me the opportunity to start buying Ferrari. Let's go over what happened with the stock and why the stock is crashing 20% in the last couple of days. The massive sell-off was triggered by the company's own guidance at its highly anticipated Capital Markets Day. Investors and analysts were expecting roaring growth from Ferrari, but what they got was a more cautious forecast that signaled a significant slowdown in the future growth of the company. We can break the investor disappointment down into 2 core problems. The first one was conservative long-term financial targets, and the second one was a scaled back EV strategy. Ferrari stock trades at a significant premium because investors expect premium growth from the company. But the numbers presented for the 2030 strategic plan simply didn't live up to those sky-high expectations. Analysts were modeling for 2030 revenue to be closer to 9.8 billion euros, but the official guidance from Ferrari, it was revenue of around only 9 billion euros. So now, at the first glance, a 9 billion euros in revenue target for a company that makes under 50,000 cars a year sounds incredible. But here's the issue. analysts calculated that the implied compounded annual growth rate, or CAGR, for earnings was only about 6% over the next few years. And that is a noticeable downshift from double-digit growth rate that the company delivered in the last couple of years. If we look at Yara IQ stock analyzer for Ferrari, the revenue of the company was growing by almost 10% in the past couple of years. And now the company guidance is a growth of almost 6%. In the eyes of Wall Street, this conservative outlook suggests one of the two things. Either the management team sees less room for price increases and personalization revenue going forward, or they're just being too cautious. So this is a habit that the Ferrari management team is known for. But this time, the gap between the company guidance and the market expectations was simply too wide. The second major piece of bad news, and arguably more forward-looking concern, was Ferrari's revised electric vehicle strategy. Back in 2022, Ferrari announced an ambitious target to have fully electric vehicles make up 40% of its product mix by 2030. At this recent Investor Day, they slashed their target in half. The new mix for 2030 is 40% ICE engines, 40% hybrids, and just 20% fully electric. While they did officially unveil their first fully electric car, the Electrica, and confirmed its launch for next year, the reduced long-term EV commitment sends basically a cold shock through the market. So why is that? Because investors are increasingly focused on the future of basically vehicle industry, which is electric. A 20% target suggests basically a hesitancy from management team of Ferrari and perhaps greater technical hurdles in translating their legendary performance into purely electric format. Basically, it raises some questions about the competitiveness of Ferrari in the long run in EV market. Okay, now that we know why the stock crashed, let's take a closer look at Ferrari fundamentals. In the last couple of years, the revenue of Ferrari is increased by almost 10% CAGR annually. Their operating cash flow growing at an even better pace at around 12% annually, and free cash flow at a similar rate of around 12%. While the management team mentioned growth can be slowed down to 6%, I don't think that would be the case. Management team has an excellent track record of delivering just above its guidance. This is only possible because the demand for Ferrari's products exceeding the supply, so the management can carefully match the annual deliveries with its targets. So I believe a growth rate of between 6 to 10% should be taken into account. The shares outstanding of the company is also going down slowly over the time, which is great. The company is extremely profitable with an operating margin of 30% and a profit margin of almost 23%. They also have 48% return on equity, which shows the management team is great at allocating capital. The current price to earnings of the stock is 38 and the price to operating cash flow is 30, which is definitely not cheap, it's high. But considering the quality of the business, the profitability of the company, and the track record, it's not unreasonable. Let's look at historical valuation of Ferrari. I'm going to focus on price to operating cash flow here. The 10-year average price to operating cash flow for Ferrari is 29. And we can see clearly in this chart that any time that the stock valuation trades lower than this average line, it was a great time to buy the stock. Particularly, we can see June 2022 here, which if we look at the price history, this has been an amazing time to buy Ferrari stock. I think we are getting close to that level again here. And based on this chart, it seems Ferrari stock is getting to an interesting range for an entry position. Okay, let's look at discounted cash flow model to see what is the fair value of the stock based on different scenarios. To start building the model, I imported a series of general parameters from Yara IQ stock analyzer into discounted cash flow calculator, like the current share price, their revenue, their number of shares, their net debt, and their operating cash flow per share. I also put my expected rate of return to be 12% to give myself a bit of margin of safety. Now in this model, I will calculate the fair value of the stock by projecting their future operating cash flow and then discount the terminal value and future cash flows minus the liabilities of the company back into the present value of the stock based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will keep their current operating cash flow margin of 33%. I considered 0% share-based compensation, 0% share-based dilution, and I assume the revenue will grow much slower at 8% in the short term, 7% in the midterm, and eventually by only 6% in the long term. I considered a terminal price to operating cash flow multiple of 24, which is much lower than the current multiple of the stock. For base case or normal case, I considered a little bit better margins, a normal revenue growth in line with analysts' expectation of 10% in the short term and 8% in the long term, and a terminal multiple of 30, which is in line with the current multiple of the stock. Finally, in the bull case or best possible outcome, I considered a nice operating cash flow margin expansion to 35%, an 11% short-term, 10% midterm, and 9% long-term growth, and a terminal multiple of 36, which is a bit higher than the current price to operating cash flow multiple of the stock. Now, if I hit calculate, the software will give me some valuable information about the stock based on my assumptions. It gives you the intrinsic value of the stock in each scenario, which ranges from $289 in the bear case to $522 in the bull case. And then it will provide you with a fair value estimate, which is $407 per share for Ferrari. And compared to the current share price of $395, Ferrari trades at 3% discount. It is basically a buy at this price range for a 12% targeted return based on my assumptions. I believe the management team can beat their own expectations, so bear case is highly unlikely. So for me, I actually started to buy Ferrari. It is just a starter position for now, and if the share price goes lower, I will dollar cost average into Ferrari and buy more shares. It is an extremely high quality business that trades at its fair value in my opinion. If you want more margin of safety, of course you should wait a little bit longer to see if the price continues to go down. In that case, it would be a great buy, and I will personally buy more aggressively at around $350. I hope you liked the analysis, and thanks for watching. And I hope to see you guys in the next video as well. Farewell.